Now we will see some other transactions that governmental entity can record. One of the major example here is inter-fund activities, and you are familiar with the concept that you learned from chapter 16 in your textbook, and you have seen some journal entries and transactions in chapter 16. Inter-fund means that money is transferred from one fund to another fund. Well, the textbook used two terms here. One is called intra-fund, when money is transferred within governmental funds or from any governmental to internal service, they use the term intra-fund. When money is transferred from any governmental to enterprise, they use the term inter-fund. And here in Baker, they use the term inter-fund activities. So the idea here is that one fund is receiving money from another fund, and that frequently happens for any governmental entities. Now you will see two major categories of inter-fund activities. One is called the reciprocal inter-fund activities. The term reciprocal means it's two-way, or you can call it exchange type transactions. That means when one fund is transferring money to the other fund, in exchange, the recipient fund needs to provide something or return the money back. That is, it's two-way transaction. And very common example here, you will see inter-fund loans. Inter-fund loans. And another example, inter-fund service provided and used. Inter-fund service provided and used. So inter-fund loans means one fund is taking loan from the other fund, and in exchange, the fund who is receiving the loan, the fund needs to repay it back. On the other hand, inter-fund service provided and used means a fund is receiving service from the other fund and need to pay back for their expenses. And it's very common, general fund can receive service from internal service fund and they need to pay back for those services. So another example of inter-fund activities could be non-reciprocal. Non-reciprocal means it's one-way transaction or non-exchange type transactions. So it's non-exchange type. And one common example is inter-fund transfer. Inter-fund transfer. This type of transfer is not as a loan. It's just one-way transfer. Money can be transferred from one fund to another fund. One common example is a general fund can transfer some money to the debt service fund to pay some interest or principal payments, and it's one-way transactions. Another example, you will see inter-fund reimbursement. Inter-fund reimbursement. That means one fund can pay for some expenses made by the other fund, and both cases, these are non-reciprocal. For example, you have seen some journal entries in chapter 16 when you have this type of inter-fund transactions. One way, the fund who is receiving money, they credit it as other financing sources. The fund who is paying money, they debit it as other financing uses. Then you will see some other examples about special items. So there might be some special items or transactions. Those are very infrequent and those are very unusual. For example, some special type of items could be a governmental entity can sell some type of their capital assets, or they can terminate some benefits related to some workforce, or they could have some early retirement plan to some employees, or they can also forgive a significant amount of debt. Those are the examples of special items. On the other hand, there could be some extraordinary items. So extraordinary items are very rare, can happen once in a while. For example, there might be some environmental disaster or calamities, or such significant damages happen because of some extraordinary events, for example, a terrorist attack. So when you have to list those items, list first the special items and then list the extraordinary items. Then it is talking about two other type of items, what you have probably seen for your regular accounting. These are deferred inflows and outflows. So deferred inflows and outflows can happen because of any acquisition or consumptions of any net assets, and payment might be made in one period, but those are applicable to future period. And that could be some usual or unique type of items, or might be some related regular items too. So now here for inflows means that you are receiving cash, money is coming, there is an inflow, but you cannot show it as regular earned revenues or part of your equity. So you are deferring it. So basically it's not, for a regular accounting, it's not a part of your equity. Rather, we show it as liabilities and we list it for after other liabilities, but before equity. On the other hand, outflows means money is out, but you cannot record it as an assets or expenses. So we of course show this type of inflows and outflows. Those are deferred because the impacts are not in the current year, rather it will be in the future year. And those type of outflows we put it on the asset side, but after reporting all regular type of assets, we will show those deferred outflows. Now you will see some common examples of deferred inflows and outflows for a governmental entity. See some other examples, very common deferred inflows and outflows. Number one example you will see for imposed non-exchange revenues. Very common examples are property taxes or fines. But if the time requirement is not met, we cannot call or record them as revenues. Rather, we will show them as deferred inflows. So one example you will see for property tax, when we estimate it, we can estimate that property tax receivables, and then we can record our credits as property tax or imposed non-exchange revenues credit, but we will show only that part which is in our current years. That means we are collecting in year one or immediately after current year within 60 days when year one ends. That part is our current part, and fund accounting, governmental funds always current focus modified accrual. So if there is any imposed non-exchange revenues that will be collected in future, not immediately in current years, you have to show that as deferred inflows, not as a revenue. Another is government mandated non-exchange transactions and voluntary transactions. So these government mandated grants you can receive from the federal government or from other government, but every time you cannot show that part as your revenues. Same thing, voluntary non-exchange transactions, which means grants you are receiving other parties, not from any other government. Rather, it could be from public or any private organizations or not-for-profit organizations. So if these type of revenues, you see that you will receive or you have to use it in multiple years, not all in current years, then you have to show that part as deferred inflows. For example, there might be some criteria. You received a grant, and the grant from the federal government, and the condition is that you have to use it in next few years, not all in 1 year. So you cannot recognize the entire amount as your current year's revenues. Rather, you will show it as deferred inflows. On the other hand, there might be some eligibility requirement. Some grant you are receiving, there might be some criteria. The employment rate for your town must go at certain level. Then the eligibility requirement is met. Other than that, although you receive the cash, you have that inflow, but you cannot call it as a revenue. So in that case, you will show it as a deferred inflows. So deferred inflows is not your earned revenues, rather it's kind of a liabilities, but we list it after all regular liabilities. Refunding of debt, it can happen. So if you want to refund your debt, you can check what's the difference between the reacquisition price of the debt and the net carrying amount of the old debt, and the difference you could show it as deferred inflows or outflows. Sales and intra-entity transfer of future revenues. Sometimes sales can happen within the fund, inter-fund or intra-fund, but again you cannot record the entire amount as revenues if there are certain criteria. That means if you see that although you are receiving the proceeds initially, all the amount, but if that sales revenue is recognized over the years or earned over the years, then you have to show it as deferred inflows. So these are very common type of deferred inflows and outflows examples. Now we will discuss about the fund balances. If you imagine the balance sheet of any fund, they will have assets on one side, and they may have deferred outflows, and then they will have liabilities on the other side and deferred inflows. Now the difference between assets and liabilities are in broad assets plus deferred outflows and liabilities plus deferred inflows. We call it fund balance. So fund balance is just like an equity portion or net position portion of a governmental entity. So fund balance term will be used for fund accountings, or usually governmental funds and internal service funds that uses the modified accrual approach. So again, it's the difference between very simple asset minus liabilities. So instead of calling it stockholders' equity or net position for fund financial statement, we will call it fund balance. And of course, you might have some here deferred outflows and deferred inflows. Now, when you prepare that fund financial statements and you show your fund balances, you have to categorize them into 5 categories. So fund balances will be into 5 categories. You have seen this concept in chapter 16. This is the same concept and review. So non-spendable fund means that you cannot use this fund because those are designated for specific spendings. For example, you will have prepaid expenditure or inventories or supplies. Those you carry forward from last year to this year, and you have to spend for those specific items. So you categorize those monies or amounts as non-spendable funds. Another is restricted fund. So these fund balances are restricted by external authorities. It could be any legislator or any donor or grantor. They could say that this fund will be used for a specific purpose. Because of those restrictions, you have to keep aside those funds and you will label it as restricted funds. Another is committed fund. So committed fund is related to some obligations based on some formal actions, and you have seen the examples for encumbrances. One example you see at the beginning of the module, that you had encumbrances for 2 trucks, you purchased 1 truck and you removed that 1 truck's encumbrances. End of the year, we eliminate all encumbrances, but that designated amount you have to carry forward from unassigned from one year to another year. Now, next category is assigned fund. There is an acute difference between the committed fund and the assigned fund. Committed fund means that you made some commitments. This amount will be used for purchasing a sanitation truck, so you are now obligated. On the other hand, assigned fund means you have some intention to use this money for specific items. You are not obligated or committed. So these are the differences. Some governmental entity can keep aside some money as their assigned fund. On the other hand, you will see all those funds that are not into your non-spendable or restricted, committed, or assigned fund will be categorized or labeled as unassigned funds. So unassigned fund balance means those are spendable, those are free funds, and you can use it for any purpose. Maybe you can give money from that unassigned fund from one governmental fund to another fund. And you will see most of the cases the general fund, which is the most important fund under the governmental category, will have huge amount of unassigned fund. So now next you will see the fund constraint and a quick summary on that. So we just learned all those categories of funds, and general fund includes most of the governmental regular day-to-day general activities, and you will see all those 5 categories under the general fund. And you will always see that general fund will have some positive unassigned funds, because general fund gets all those tax revenues. Either it's imposed tax revenues or derived tax revenues, or general fund can also get some government mandated revenues or grants or voluntary grants. So usually general fund will have huge amount of positive unassigned fund balance, because general fund, they can give money to any other funds. On the other hand, other categories, special revenue funds, debt service, capital project, and permanent fund, you will see they may get all those fund supports from the general fund. So in case of unassigned category, you may see most of the cases the amount is negative. And these are, if you remember, these are the 5 major types of funds under the governmental fund, what you know using the acronyms GSCDP, or the Baker book uses the term GRASP. Now we are talking about the modified accrual, where the differences between the assets and deferred outflows and liabilities and deferred inflows are known as fund balance. Now, if you think of government-wide financial statements or the other funds, especially proprietary funds, internal service or enterprise fund, they use the accrual method. So for accrual method, when you will see the differences between the assets and liabilities, or assets plus deferred outflows and liabilities plus deferred inflows, those balance for government-wide and enterprise funds, we call it net position. So this is also kind of the equity, but for that financial statements or balance sheet, we call it statement of net position, or the difference, we call it net position. This net position will be also categorized into 3 categories: net investment in capital assets, that could be any investment in tangible or intangible asset, and net position could be restricted. That restriction usually comes from any grantor or creditors, externally imposed restrictions to use that fund, and unrestricted means the all other funds or the net positions, the net amount that is not included in net investment, in capital assets, or in restricted net position funds. So unrestricted means those funds that you can use for any purposes. Now we will go over some sample questions from that unit. First question, the city of Curtain had the following interfund transactions during the month of May. Billing the internal service fund to a department financed by the general fund, and the service amount is $5,000. Transfer of a $200,000 amount from the general to establish a new enterprise fund. Routine transfer of $50,000 from the general fund to debt service fund. Now, these interfund activities you have to categorize into reciprocal and non-reciprocal, and the question is, what is the total of the reciprocal interfund activities? So if you remember from the previous lecture, interfund activities could be categorized either as reciprocal, which is two-way transactions, or as non-reciprocal, which is one-way transaction. So you see these two items here. General fund is providing some contributed amount to establish a new enterprise fund, and this is routine transfer, probably to pay some debt obligations or interest that general fund is transferring to the debt service fund. On the other hand, if you see the first item, which is the amount, it's because of some service provided, right? And the internal service fund provided some service to the general fund, and in exchange of that service they have to pay this $5,000, which is two-way or exchange type transaction. So the reciprocal means here exchange type transactions, which includes interfund loans and interfund service provided and used. So the amount here will be $5,000. Assets such as property tax receivables associated with unavailable revenues, property tax collected more than 60 days after the year end, should be recorded as what? So, we follow the current resource focus approach for the general fund and all governmental funds, and we record the portion as revenue which you can collect in current years or immediately after current years. For tax example, you have seen that the portion of the tax that you will collect within 60 days after the fiscal year ends. Here, if you have any property tax receivables that will take more than 60 years to collect, you cannot record that part as an earned tax revenue. So in that case, you have to show that part as a deferred inflow. So deferred inflow is not a part of your recognized or earned revenues, rather it's kind of in between liabilities. So we put it next to the liabilities, but we move that part from our revenues and we call it as deferred inflows of resources. Next question. General fund resources that are limited to use by constraint imposed by the law through constitution or enabling legislation should be classified within what fund balances? So you just have learned about different categories of fund balances, and if you remember, if there is any restrictions imposed by any external parties such as grantor or creditor or legislator, that you have to keep that fund because of those legislations or constraint imposed by other parties, we put those or label those under the restricted fund balance category. Now, the only fund that should have a positive unassigned fund balance is the general fund. As we discussed, general fund received like huge amount of tax revenues, derived tax or imposed property tax or any other type of government mandated or voluntary revenues, and that is a huge source for any government, and that we record usually in the general fund. And then you will see general fund will have huge amount of unassigned fund. That means they can spend those funds for any purpose, or they can transfer the fund to other funds. So general fund usually have positive amount or positive unassigned fund balance. On the other hand, other funds you will see under the governmental, they will have negative unassigned fund balance.